Okay, hey everyone, welcome back to another episode of Who Charted. Today is Monday, November 17th, 2025. We're going to get right into it. Market kind of put in a sideways week last week, and honestly, to me, everybody kind of deserves a breather if you're kind of reading our commentary. Look, the market's been running hard and running fast from the April lows. A breather makes perfect sense here. If we kind of zoom out, last week we zoomed in, but this week we're going to zoom out and go back to our weekly charts. S&P 500 up here, NASDAQ 100 down here. And since those April liberation lows, the S&P 500 has returned about 43% from trough to peak. NASDAQ 100, 58% from trough to peak. Think of it in terms of if you were a sprinter and you were running hard, laps on the track, wherever you do your sprinting. I obviously do not, but you need a break every now and then. So for the past 2 weeks, we've had some sideways activity here on the weekly chart for both of these major indices. It makes perfect sense. Nothing goes up in a straight line. Some would argue that a move like that is somewhat unsustainable. So a little pause that refreshes here, a little breather, makes a lot of sense to me for the major indices. No clear break of the trend. Now let's zoom back into the chart that we looked at last week. Last week, we highlighted the fact that down here, we had 4 consecutive days where the NASDAQ 100 and the S&P 500 closed at or below the lower Bollinger Band. Well, guess what? That's setting up again. We got the pop that we were looking for. Pop, little gaps here, gaps here. All right, rallies to the upside before fading on Wednesday, Thursday, and then Friday. A little bit of a rally back on Friday, large white candles here, but still below the Bollinger Band in both instances. Now, the setup that we look for multiple days below or at the lower Bollinger Band. So that honestly is in play again. So despite the pop that we got early last week, the actual weekly data, if we go back to it, looks like a flat week, right? S&P 500 and NASDAQ were both relatively flat on the week, but the setup remains there. Now, the question is this. Are we broken? Right? If you're bearish, the question you need to ask yourself is, are we broken? And the simple fact of the matter is we are not. This is the NYSE advanced decline line. Is there a divergence in play? Yes. We've been trending lower, even as the market was making higher highs. Now, what we like to look at is quantify this. And one of our biggest pet peeves is people talk about divergences. Oh, there's a divergence, right? They're doing ocular regression. It's lazy analysis once again. Quantify it. Well, how do we quantify that? The 1-year range rank. The 1-year range rank is simply a 1-year stochastic. Up here near 100, it means the AD line is at a 1-year high. Down here at 0, it means the AD line is at a 1-year low. 50% would mean the AD line is right in the middle of the range of where it's been for the past year. We are currently at 64, call it 65%. Now, until you get a sustained breakdown below 60, such as you did here in early 2022, it's hard to make a case for a prolonged downward move in prices, okay? We've had some blips where we've gone below and quickly recovered, right? And markets also quickly recovered. It's when you get the sustained move below 60 on the 1-year range rank of the advanced decline line that you start to run into bigger issues, number one, for the AD line, and number two, for the broader market. We're not there yet. Look, ideally, we'd love to be here, right? We'd love to be above 80, right? Above 80 is where we spent much of 2024. It's also where we spent a lot of 2023 once we started to rebound. However, we're not there right now, all right? And we can't make the market go there. However, until we break 60, it's hard to get really, really bearish, in my opinion. Now, let's talk about uncertainty, right? There is certainly uncertainty in the market. That sounds weird. Anyway, there's certainly uncertainty in the market. And to me, I think it relates to the Fed. And why? Well, earlier this year, the market was pricing in 3 rate cuts. We've gotten 2 rate cuts so far. Now, we haven't had data, government shutdown. Nobody really knows what the Fed is going to do. We can kind of back ourselves into it by looking at the spread between the 2-year yield and the effective fund rate. Right now, that spread is about 30 basis points. So the market is pricing in at least one more rate cut. After that, right, what happens in 2026? I don't think anybody really knows. That is a source of uncertainty. So if I'm thinking about markets as we kind of have had a monster run off the April lows, this is a logical place to take a break, right? The government has now reopened. We're going to start to get data. We'll get a better read on what the Fed might do. So to me, logical place to pause, especially if we're going to gear up for a rally into the end of the year. In the really short term on those Bollinger Bands, the setup could be there. I emphasize could in all caps, right? Nothing is guaranteed. The setup could be there for a short-term pop. We will watch how it plays out this week. So that's really all I have as we start the new week. Just a quick reminder here, or a quick note: there will not be a video next Monday. I will be working from somewhere else for the holiday week, so I hope everybody has a great Thanksgiving, spending time with the people who mean the most to you. As always, thanks for watching, and we will touch base in 2 weeks.